Welcome back to Factful Finance. Let me ask you, how well do you understand the market cycles? You've probably heard that the economy moves in cycles: expansion, peak, recession, and recovery. But here's the million-dollar question. How does your investment strategy need to shift depending on what phase the economy is in? It's more important than ever to understand asset allocation and how it can help you make informed decisions in any economic environment. Today, we're diving deep into asset allocation strategies for different economic cycles. Whether you're facing a booming economy or a market downturn, the right strategy can make all the difference. Before we dive in, a quick disclaimer. This content is for educational purposes only. Always consult a certified financial professional for personalized guidance. Now let's break this down step by step. During periods of economic expansion, think of it like a rocket taking off. Stocks are generally strong, businesses are thriving, and people are spending. This is the time to lean heavily into equities. Studies show that equities outperform other asset classes during economic booms. Historically, the S&P 500 has returned an average of about 10% per year during expansions. The key here is to focus on growth assets, stocks, particularly in sectors like technology or consumer discretionary, which benefit from increased spending. But what happens when things start to slow down? When the economy hits its peak, you're still in growth mode, but the risk is climbing. This is when you need to start balancing your portfolio, trim the growth, and add a bit more stability with bonds or defensive stocks like utilities or consumer staples. This strategy helps cushion your portfolio when the inevitable dip occurs. And that brings us to the recession phase. The party is over and the market contracts. Now the focus shifts. This is when you want to prioritize capital preservation and focus on low-risk investments. Government bonds or high-quality dividend-paying stocks are often a safer bet during these times. Remember, the idea isn't to avoid stocks altogether, but to pivot toward those that can withstand economic shocks, like those in the healthcare, consumer staples, and utilities sectors. During the recovery phase, the market begins to climb out of the recession's shadow. This is the perfect time to shift back to growth, but with a keen eye on risk. Increase your exposure to equities, but be selective. Start adding more cyclical stocks, industries that thrive as the economy rebounds, like industrials, financials, and technology. Take a moment to think about Amelia, a long-term investor. During the 2008 recession, Amelia made a key pivot. She added more bonds to her portfolio when the market started to tumble. In 2009, as the market bounced back, she slowly increased her equity exposure, focusing on industries like tech and consumer discretionary. By the time the market was fully in recovery, her portfolio had rebounded, and she was poised for growth as stocks started outperforming again. Now let's talk about how you can optimize your strategy. A crucial aspect to consider is risk management. It's not just about picking the right assets. It's about knowing how much risk you're willing to take at different stages of the cycle. During a peak or recession, reducing risk can help preserve capital, while during recovery or expansion, taking on a bit more risk can boost returns. Also, consider rebalancing your portfolio regularly to align with changing market conditions. Rebalancing ensures you're not too exposed to any one asset class, keeping you agile and ready to respond when the cycle shifts. If you're not sure where to begin, you could start by using a 60-40 portfolio, 60% equities and 40% bonds. During a booming economy, you can shift more towards stocks. During a recession, you might want to increase your bond allocation. Want to know what's next? Well, in the world of asset allocation, there's always more to learn. Be sure to hit that subscribe button so you don't miss the next breakdown of financial strategies that will help you optimize your wealth-building efforts. Which of these strategies resonates with you? Drop a comment below. I respond to as many as I can. And don't forget, understanding these strategies, paired with a disciplined investment approach, will make sure you're ready for anything the economy throws your way. If you found this video helpful, you'll love the deep dive we're doing next. Just click on the video on screen to learn more.